morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're touching on financial results of Canadian-owned banking giant First Caribbean International Bank, and we are also taking a look at international markets with the recent fallout arising from not just growth and inflation concerns, but also very sharp increases in geopolitical risk. And of course, we're talking about that invasion or incursion by the Russian military into the Ukraine and what it has been doing to financial markets. So let's take a look firstly at financial results here in the Caribbean, and then we'll touch very quickly on the broader international scope. So looking at First Caribbean's first quarter results for that quarter ended January 2022, the group would have reported a TT dollar equivalent earnings per share of 19 cents, which was a 47% improvement from the 13 cents per share recorded in the prior comparable period of first quarter 2021. Now, impressively, revenues were up 8.4%, still below some of the more recent periods, pre-COVID periods, but nonetheless up 8.4% from 872 million TT equivalent to 946 odd million TT equivalent. Operating expenses also increased by a less than proportionate 8.2% from 603 to 653 odd million. There was an actual reversal in credit loss expenses from a charge of 42 million to a reversal of 49.4 million, which certainly helped improve earnings for over the comparable periods. And net income attributable to equity holders improved at 48 odd percent from 202 odd million to just under 300 million TT equivalent. Now, when we take a look at that revenue story, it was a story of recovery when we look at the past few comparable first quarter performances for FCI. And there was pretty much treading water in terms of net interest income, a very marginal 0.4% increase from 601 to 604 million TT equivalent. The big change, however, was in that other operating income, which improved 26 odd percent from 271 million to 342 odd million TT equivalent, overall contributing to that over 8% increase in revenue for FCI. So certainly a positive development for the banking group, which would have improved their revenues quarter over comparable quarter. When we take a look at profit before taxes by segment, some very noticeable changes and improvements for the corporate and investment banking segment in that green color, almost 45% increase from 229 to 384 million TT equivalent. Wealth management improved in percentage terms just over 50% from 6.1 million to 9.3 million, but certainly well short of those PBT figures generated in prior comparable periods. And the retail business and international banking segment swung from a loss of 15 million TT equivalent in the first quarter of 2021 to a profit of 13 million TT equivalent in that first quarter of 2022. So at a price of $6.08, FCI is trading at a price to earnings ratio of just around 10.5 times, which compares quite favorably to the current banking sector average of 19.6 times. Certainly, the banking sector average, as would have been mentioned in multiple previous Bourse reports, has certainly become a little bit elevated over the past few months, but FCI is one of those exceptions to the rule. So for investors looking at the banking sector average and looking at FCI, it does represent relatively significant value with a dividend yield of 2.2% compared to that sector average of 2.5%, which we anticipate to increase over the coming quarters. So on the basis of improved revenues, reversal of credit loss provisions, but with one eye on financial market volatility, Bourse is going to maintain an overweight rating or assign an overweight rating to FCI stock for the time being. Now, we spoke about the impact and the fallout of the Russia-Ukraine invasion or Russia-Ukraine war over the past couple of weeks and on international markets. And certainly we've seen it playing out in terms of investor reaction and sentiment, with Asian markets down 11.1% in 2022, European markets down just around 13%. The one exception being Latin America, which is recovering from two challenging years, up 17%, and the US markets down 9.6% as of Friday. Actually, they were down closer to just under 12% in terms of their major equity market benchmark, the S&P 500. Now, Russia's country index or country ETF has actually declined 78.8% since the start of the year, and that has been attributable in large part to many of the sanctions that would have been placed on Russia since their February 24th invasion into the Republic of Ukraine, with the closure of A&C space by the US and many other EU countries. Bond and equity markets have been traded, bond and equities of Russian companies have been suspended in terms of trading, and that has led to a mass exodus out of stocks, bonds, and ETFs of the Russian investment space and Russian investment complex. The country's sovereign assets, including their national wealth fund and central bank assets, have also been frozen. Russian banks have been isolated with their access to the international messaging system frozen or blocked. Most recently, the trading status of Russia is now at risk, with the risk of being removed from preferred trading partner status from the US as well as many other EU countries. And there has also been the freezing of assets of Russian persons of interest. And all of this has really moved to squeeze the Russian government and Russian citizens and generally dissuade or create a strong dissuasive effect for Russia in terms of their inclusion into the Ukraine. Now, for investors, those geopolitical tensions form part of a very long list of market drivers which should be paid attention to, including significant inflationary pressures, and certainly with the sanctions placed on Russia, that has led to speculation of increased inflationary pressures, with Russia being a key supplier of ammonia, as well as energy commodities and other key agricultural commodities, including wheat, at the global level. Now, slowing growth has also remained another key factor or driver for markets over the coming months, as mentioned, that geopolitical tensions and the U.S. Federal Reserve's increasing U.S. interest rate policy, which is on the cards, is also on the minds of investors. So for investors, what should you be looking at over the next couple weeks or months ahead? Well, if you are higher risk tolerant, you could look at this as an opportunity to average into your equity positions and add to your equity portfolio. Focus on value stocks as opposed to the very speculative high growth oriented stocks. If you are on the lower risk side, of course, you could stay in cash or near cash, utilizing purchase agreements or income-oriented mutual funds. Certainly some very exciting times ahead, very unnerving times ahead for investors. And we will, of course, as Bourse, keep you updated. But that's it for this week's edition. For more information, give us a call at 226-8773. Email us at invest@boursefinancial.com and check out our website at bourseinvestment.com. For all of our research, which is absolutely free, and you can catch us in the business section of today's Trinidad and Tobago Guardian newspaper. Stay safe, get vaccinated, and see you next week on the Bourse Report.